$1.75 trillion. That is the number that stopped Wall Street in its tracks on June 12, 2026. SpaceX went public, and in a single trading session became one of the most valuable companies on Earth. But here is the thing. The rockets are almost beside the point. In the next 12 minutes, we are going to break down what this valuation actually means, where the money is really going, and what everyday investors need to know before touching this stock. Let us start with the raw numbers from the SEC filing. SpaceX priced its IPO at $135 per share on June 12, 2026. The deal was led by Goldman Sachs and Morgan Stanley, two of the most prominent underwriters in the country, which itself signals how seriously Wall Street treated this listing. By the close of day one, the stock was sitting at $160.95, a gain of 19% in a single session. That put the market capitalization at $1.75 trillion. To raise that capital, SpaceX sold shares worth $75 billion, one of the largest single capital raises in the history of financial markets. Trading volume on day one was extraordinary even by IPO standards. Most major IPOs see heavy opening volume that tapers off within the first hour. SpaceX sustained elevated volume throughout the entire session, reflecting both institutional buyers filling large positions and retail investors rushing in after the open. Of that $75 billion raised, it is worth understanding the split. A portion was primary, meaning new shares issued by the company, with proceeds going directly to SpaceX's balance sheet. A portion was secondary, meaning existing shareholders, including early employees and venture backers, cashing out. The S-1 filing disclosed both categories, and the secondary component was significant, meaning a meaningful share of that $75 billion went to people who were already inside the company. Now here is where it gets interesting. SpaceX reported total revenue of $18.6 billion in 2025. At a $1.75 trillion valuation, that puts the price-to-sales ratio at approximately 94 times. To put that in plain English, for every $1 SpaceX earned last year, investors are paying $94 to own a piece of it. If SpaceX grows revenue at 30% annually for 3 years, which would be aggressive but not unprecedented for a high-growth company, revenue would reach roughly $32 billion by 2028. At that point, the current valuation still implies a forward price-to-sales ratio above 50 times. Compare that to some of the largest companies in the world right now. Meta trades at roughly 11 times revenue, Apple at 9 times, Netflix at 8.5 times, Alphabet at 7.4 times, Amazon at 3.5 times. SpaceX is not trading at double or triple those multiples. It is trading at 10 to 25 times higher. That is not a growth premium. That is a completely different category of bet. To understand just how extraordinary a 94 times revenue multiple is, we need to go back through IPO history. The previous benchmark for the largest IPO ever was Saudi Aramco in 2019. Aramco raised $25.6 billion and briefly hit a $2 trillion valuation. But Aramco is an oil company with decades of proven cash flow. Investors were not betting on a dream, they were buying a money printer. Before that, Alibaba's 2014 IPO raised $25 billion, which at the time was considered staggering. ARM Holdings went public in 2023 and raised $4.9 billion at roughly 30 times revenue, and analysts called that aggressive. SpaceX raised $75 billion at 94 times revenue. That is in a different universe. Now, what is the closest historical parallel? The dot-com bubble of 1999 and 2000. During that period, internet companies routinely traded at 100, 200, even 500 times revenue, before most of them collapsed entirely. Companies like Pets.com, Webvan, and eToys raised billions and then went to zero within 2 years. We are not saying SpaceX is Pets.com. SpaceX has real revenue, $18.6 billion of it. It has a profitable satellite business and a launch monopoly on several government contracts. But the valuation math requires that SpaceX become something dramatically larger than it is today. To understand what happens to high multiple stocks over time, consider two very different examples. Tesla hit a price-to-sales ratio of roughly 23 times in November 2021, far below SpaceX's current multiple. From that peak, Tesla's stock fell approximately 75% over the following 14 months. The business kept generating revenue, but the multiple compressed hard. Nvidia, by contrast, reached a price-to-sales ratio of around 40 times in 2023, also well below SpaceX. But Nvidia held its valuation and kept climbing. Why? Because the earnings actually materialized. Nvidia was not just growing revenue, it was converting that revenue into massive profits at a pace that justified the premium. That is the key lesson from both cases. Price-to-sales compression versus earnings growth. If earnings arrive faster than the multiple compresses, the stock works. If earnings disappoint and the multiple falls, the stock falls with it, sometimes violently. Amazon provides a longer timeline. During the dot-com era, Amazon traded at extraordinary multiples relative to its revenue. Then the bubble burst. The stock fell roughly 90%, and for years it looked like a cautionary tale. It was not until around 2015, roughly 15 years later, that Amazon's business had grown enough to fully justify even its post-crash valuation. At 94 times revenue, investors are not paying for what SpaceX did last year. They are paying for what they believe SpaceX will be worth in 10 or 15 years. And that belief is almost entirely built on artificial intelligence, not on Falcon 9 launches. So what exactly are investors paying for? The answer is in the SpaceX S-1 filing, the document the company submitted to the SEC before going public. In that filing, SpaceX claims a total addressable market of $28.5 trillion. That number is so large it is almost incomprehensible. For reference, the entire United States GDP in 2025 was roughly $29 trillion. SpaceX is claiming its potential market is essentially the size of the entire American economy. But here is what most headlines missed. 93% of that $28.5 trillion market is attributed to XAI, Elon Musk's artificial intelligence division. Not satellites, not rockets, not Starlink, artificial intelligence. And it is worth being direct about what that number represents. It is a speculative total addressable market figure. It assumes XAI wins a dominant share of global AI compute demand across every major industry. That is not a forecast backed by current contracts. It is a ceiling for what the market could be if everything breaks in SpaceX's favor. Now let us look at what SpaceX actually earned in 2025. Starlink, the satellite internet service, brought in $11.4 billion in revenue with an operating profit of $4.4 billion. That is the genuinely profitable part of the business. As of early 2026, Starlink had approximately 5 million subscribers paying an average of around $190 per month. That recurring revenue base is real, growing, and strategically defensible. The trajectory of that subscriber growth draws comparisons to Amazon Web Services in its early years. A business that looked like a side project until it became the engine of Amazon's entire valuation. Rocket and launch services generated $7.2 billion. Those two combined get you to $18.6 billion in total revenue. The XAI division, it posted an operating loss of $6.4 billion in 2025, and per the S-1 disclosure, it is on pace to burn through $10 billion in 2026. Xai's flagship product, Grok, competes directly with OpenAI's ChatGPT. In terms of user adoption and enterprise market share, Grok trails ChatGPT meaningfully as of early 2026. That gap is the central challenge for the AI bull case. The unit economics of AI infrastructure are brutally competitive, and second place in that race has historically not been a profitable position. So the profitable business Starlink and launches is funding a massive AI bet that has not yet produced a single dollar of profit. The bull case is that XAI becomes a dominant player in the global AI infrastructure race, and that $28.5 trillion market becomes real. The bear case is that AI infrastructure spending consolidates around a few winners, and SpaceX's AI division keeps burning cash while the 94 times multiple slowly compresses. Going public does not just change SpaceX's access to capital. It changes its relationship with the federal government in ways that are complicated and, frankly, unprecedented. SpaceX holds some of the most significant government contracts in modern history. NASA's Artemis program relies on SpaceX for lunar landers. The Department of Defense uses SpaceX for classified satellite launches and for Starshield, a national security version of Starlink. Historically, publicly traded companies face more scrutiny when they hold those kinds of contracts. because shareholders now have a legal right to financial disclosures that can sometimes conflict with classified program requirements. There is also an antitrust dimension that regulators are watching closely. SpaceX controls more than 80% of U.S. commercial launch services by volume. That is a near monopoly position in a sector that is critical to both national security and commercial satellite deployment. When a company at that scale goes public and raises $75 billion in new capital, it draws attention from antitrust regulators, asking whether that capital could be used to further entrench the dominant market position. Beyond antitrust, there is contract risk that changes with every administration. Government priorities shift, NASA budgets get restructured, DoD spending allocations move. The contracts SpaceX holds today are real and valuable, but they are not permanent, and any future administration has the authority to restructure, reduce, or redirect those programs. That kind of policy risk is harder to price into a stock than a revenue number. The SEC is also paying close attention to mega IPOs of this size. Following the 2023 wave of large technology listings, the SEC introduced enhanced disclosure rules for companies with valuations above $500 billion at listing. SpaceX had to provide more granular breakdowns of government contract revenue, AI investment spending, and executive compensation than a typical listing would require. There is also the quiet period. Following the IPO, SpaceX executives are restricted from making public statements about the business, forward guidance, strategic updates, commentary on financials, for a set window post-listing. That means investors are essentially flying without a map for weeks after day one. No earnings call, no management commentary, no updated guidance. For a company where the valuation is almost entirely based on future projections, that silence creates real information asymmetry in the market. There is also the question of retail investor access. In most major IPOs, institutional investors, pension funds, hedge funds, sovereign wealth funds, get the shares at the IPO price. Retail investors, meaning everyday people with brokerage accounts, typically cannot buy in until the stock opens for trading on the exchange, by which point the price has already moved. In SpaceX's case, the stock opened 19% above the IPO price. Retail buyers on day one were already paying $160.95, not $135. There are also standard lockup periods. Early employees and insiders are typically restricted from selling their shares for 180 days after the IPO. That means a large supply of shares could hit the market roughly 6 months after the June listing date. Let us talk about what this actually means if you are a regular person with a brokerage account. First, can you buy SpaceX stock right now? Yes. As of the IPO, SpaceX trades on the NASDAQ under its ticker. You can buy shares through any standard brokerage, Fidelity, Charles Schwab, Robinhood, whatever you use. There is no special access required. But should you? That is a risk question, and the 94 times revenue multiple is the key number to understand. When a stock trades at that kind of premium, it means the current price already assumes enormous future growth. If SpaceX hits every target, XAI becomes profitable, Starlink doubles its subscriber base, launch revenue grows, the stock may hold its value or grow. But if any of those bets fall short, the multiple compresses, and the stock price can fall significantly even if the company is still growing. Here is the concrete math. The SpaceX's price-to-sales ratio compresses from 94 times down to 30 times, which would still place it above every major technology company in the world, and revenue stays flat. The stock falls roughly 68% from its day one close. That means a share that traded at $160.95 on June 12th would be worth approximately $51. The business would still exist, the rockets would still fly, but the valuation would have been cut by more than 2/3. We have seen this movie before. Rivian went public in 2021 at a massive premium. The market was pricing in a future where Rivian dominated electric vehicle production. Within 2 years, the stock had fallen roughly 90% from its post-IPO high. The business did not disappear, but the valuation assumptions collapsed when growth targets were not met on schedule. This is what happened to many high-multiple tech stocks in 2022 as well. Companies that were trading at 50 to 100 times revenue fell 50 to 80%, even though their underlying businesses were still generating real revenue. Now, for people with employer-sponsored retirement accounts, your 401k, it is worth understanding how this actually works. Most standard 401k plans invest in mutual funds or target date funds, not individual stocks. That means most people will not have automatic SpaceX exposure through their retirement plan. If you want to own SpaceX shares, it requires a deliberate decision in a self-directed brokerage account. It is not something that will just appear in your retirement balance without your choosing it. For index fund investors, the picture is different. If you hold a broad market index fund that tracks the S&P 500 or the total stock market, SpaceX will eventually be included as it meets weighting criteria. That means passive investors will get automatic exposure whether they choose it or not. Third, for context on scale, at $1.75 trillion, SpaceX is already larger than Berkshire Hathaway, Eli Lilly, and JP Morgan Chase. It is the 7th or 8th largest company in the United States by market cap on its first day of trading. This is not a small bet. It is a statement about where investors think the next decade of value creation is coming from. Here's the one-sentence takeaway. SpaceX's $1.75 trillion valuation is not a bet on rockets. It is a bet that Elon Musk wins the AI race. Whether that happens is something the market will spend the next decade figuring out. So we want to hear from you. Did you buy SpaceX shares on day one, or are you sitting this one out? Drop it in the comments below. If you found this breakdown useful, hit the like button and subscribe. We cover the numbers behind the headlines every single week.